Action.
Hi guys, welcome to our first episode of AAFS Uncut, and we have a very special guest today, Justin Ong, which is one of our mortgage broker at AA Finance Solutions. Welcome, Justin.
Thanks very much,
See
Leonard.
you, man.
Shouldn't introduce me as a special guest because I don't think I'm that special. I'm here every single day, working together with you.
We are very honored to have you on board.
You're not treating me as part of the team. That's why I am a special guest. Huh?
You are a very special guest.
Okay. So what are we going to talk about today?
So today we'll be talking about some of the factors that can impact your borrowing capacity. So I just want to get your thought on it. I mean, just give us some example of what some of the income and liabilities they may impact like your borrowing capacity. So I reckon number one, I'll start with, let's say, from the bank point of view. How do they look at the income or the commitment? Like, what are some of the things that they're looking for in general?
Okay. So, in terms of income, let's start with somebody who is working on a permanent full-time basis, what we normally call the PAYG customers. Their yearly salary is what we're looking at. They may get paid fortnightly, monthly, or even weekly.
Yeah.
How is that going to affect their borrowing capacity? That depends on, well, income is just one component of the whole equation. We should take both income expenses into account.
Absolutely. Yeah.
So first of all, you have got your gross wages, salary. Take away the tax. You have got your net income per month or per year. You have to take into account of your monthly living expenses as well. Whatever that is left over, those would be your net disposable income.
Yep.
That the bank is going to use to calculate your borrowing capacity.
Absolutely.
So that's pretty much the impact in a nutshell
Yeah.
of your level of income.
That's a very good point. I think that pretty much summarizes the big bulk of it. So let's talk about some of the expenses. For example, what do you reckon liability expenses? What some of the things that the bank will look at that may impact your borrowing. So I think some of them are from like the kids, the amount of children that you have, that will be considered as expenses. And that may reduces the borrowing capacity. So what do you think of that?
Okay, so when you when you bring up kids, the first thing come to my mind is your family circumstances, your personal family status. You're single, you're married, you're in a de facto relationship, you're married with kids. How many kids have you got? One dependent, two dependents, or even more. So how is that gonna affect your borrowing capacity? How do banks or lenders take those factors into account? It is the assumed minimum living expenses that they're going to use to calculate your living expenses. So
Right, yeah.
let's say
I think with the kids, the more kids that you have, I think there will be more expenses that you will incur, isn't it?
correct.
Yeah.
So obviously you're trying to compare two different scenarios.
Yeah.
Scenario number one, you're single.
Yeah.
Scenario number two, you're married with two dependents with two kids. The living expenses will be much higher in the
Absolutely.
second scenario. Then it wouldn't surprise me if the level of borrowing is not going to be as good
Yeah.
as the first one.
Absolutely. in each kids, there will be costs like your education, or like school, your childcare expenses. So obviously that can impact the borrowing capacity as well.
Absolutely. So since we are talking about school fees, we talk
Mm.
about childcare. Each lender, at least in Australia anyway, each lender would have a an index or benchmark that they use that is called HEM.
Yep. Yep.
HEM. Does it stand for household expenditure measurement?
Correct. Yeah.
Well, I think that's what it's called, isn't it? So that would be the minimum benchmark lenders would use, that can sustain the basic expenses of an average household. But of course, on top of that, if you send your kids to private schools, if you send your kids to childcare, and you pay for extra curriculum, some
Yep.
classes,
Yeah.
there's a good chance that it's gonna,
Impact your borrowing.
yes,
Yeah.
it's gonna be it's gonna cost you more than the HEM
Absolutely.
that was applied by
Yeah.
the bank. So
Yeah.
the banks will always use the higher of the two.
Yep. Let's move on to the next one, which is for credit cards. Credit card, personal loan, car loan, store cards. Like, how are these things can affect your borrowing capacity?
Okay, now for credit cards, most of us have credit cards anyway, if not all of us. Even if so this is what we come across very often, right? We all have credit cards, different level of limits. We use them. We always pay them in full, without incurring any interest expense, right? But from any lender's point of view, from bank's point of view, they will always make the worst case scenario by
Correct.
assuming that you
Correct.
max out your card. If you maxed out your credit cards, what will be the minimum monthly repayment that you have to make?
Correct. Yeah.
So in that sense,
Yeah.
the bigger the credit card limit, in other words, the bigger the impact
Correct.
that
yeah.
it will have, the bigger the negative impact, I
Yeah.
should say, it will have on your borrowing capacity. Even if you don't spend a whole lot,
Yeah.
it will reduce your
Borrowing capacity.
borrowing
That's a
capacity.
very good point, because I've come across client who pay off their credit card every single month, but they come and say to us saying, "Oh, why do we need to declare this? Because it will be zero every single month." And you summed it up perfectly, because the bank will look at the worst case scenario, and they would always use or they will assume that you will max out your credit card every single month. So yeah, I completely agree with that. How about the home loans, Justin? So the home loans, how is that? Any of your existing home loan, how is that impacting your borrowing capacity?
So home loans, how is that going to affect your borrowing capacity? You can treat it. You can treat the minimum monthly repayment
Right.
of your existing home loans
Yeah.
as part of your expenses, right?
Okay.
So coming back to the formula, coming back to the equation that we talked about just then, you've got your net disposable income.
Yeah.
After taking away the minimum repayment that you have to make for your credit card, take into account of the minimum monthly repayment for your existing housing loans as well. Once again, is there any surplus left in terms of your disposable income?
Yeah.
If there is,
Yeah.
meaning that you might be able to borrow a bit more. If you got none left, well, it's easy. That means you max out your borrowing
Right, yeah.
capacity.
And this is a very interesting one, because this sort of been coming in probably in the last 2 to 3 years. I'm talking about those buy now, pay later. So I'm talking about those ZPay, Leverage Pay. How are these impacting the borrowing capacity, or does it actually Does it actually impact the borrowing capacity, or it doesn't? What are your thoughts on those things?
My honest response
Yeah.
is that I am not 100% sure.
Okay.
When I am not 100% sure about this sort of questions, the first person that I normally go to is yourself. So I'll take that as a test.
Yeah.
So if I ever come across with that kind of scenarios, I would treat them like a form of personal loans.
Yeah.
You buy now, pay later. What that really means is you buy the item, you buy the items. You don't have to pay the full amount right now straight away, but you pay it. You make the payments in separate installments. So it sounds to me that it operates like a personal loan. So therefore, when I put
Right.
this data into our calculation, I'm gonna treat them as a personal loan, or maybe I can put them down as part of the living expenses as well, because they should be part of your ongoing expenses, at
Correct,
least for
yeah,
the time being.
yeah. So yeah, you're absolutely right. So to summarize it nicely, so one is for most buy now pay later, if they given like a store card, then yes, they will consider it as like your normal credit card. So treat it that way. Otherwise, it'll be just part of your living expenses, your recreation spending, so on. Yeah. So and that definitely will impact your borrowing
Ab-
capacity
abs-
as well, unfortunately.
Absolutely,
Yeah, so be careful with those.
Yes.
Yeah, so I think some of the, not everyone will have this, but hacks that, how does that impact the borrowing capacity as well?
It does for hacks, and the level of impact may vary. The reason why I say that is because how much you have to pay back for your hacks depends on very much on the level of income that you're making.
Correct.
So in other words, the higher the level of income that you're earning, the more hacks
Exactly.
that you have to repay for
Yeah.
that financial year.
Yeah.
So in other words, if your level of income is not that great, it's not that high, the repayment is not going to be that much for the financial year as well.
Absolutely. Yeah. So I think hacks there will be certain threshold as well, if I'm not mistaken. So if you're earning below, if I'm not mistaken, $50,000, say sorry, 45,000. I think you don't have to pay any of the hacks that back.
It sounds about right,
Yeah.
but once again, I'm not 100% sure. So this is a
Yeah.
time when you want to deal with this sort of specific technicality of this kind of calculation. We
Yeah.
would just jump on to the website to
Have a look.
find out.
Absolutely.
To find out, and
Yeah.
especially whenever we come across with something that is related to tax, it's always a best practice to revisit the website to make sure that understanding is still up to date.
Yep.
They
Yeah,
do
absolutely.
change every now and then.
So just going back to the income, Justin.
Yes.
So just a rough idea, right? How does this increases in interest rate? Do you reckon how is that going to impact the borrowing capacity?
Okay, so let me take a step back and try to explain what sort of interest rates that banks use to calculate our ability to repay the housing loan. Whatever interest rate that you're being offered, banks will always put some buffer on top of the product rates that you're entitled to. So for example, if your housing loan interest rate is 2.5%, these days the standard would be 3%, isn't it?
Correct. Yeah.
So the banks will top it up with another 3% when they calculate the monthly repayment for your housing loan, even though that's not the rate, that's not the repayment that you make.
Yep.
But the banks want to make sure that with your current level of income or
Yeah.
net disposable income
Yeah.
is able to sustain such level of monthly repayment.
Yeah.
So in other words, you can imagine if interest rate is increasing at the moment,
Yeah.
From 2.5%, just using that as an example, from 2.5%, we add a 1/4% of an interest rate rise, so it ends up becoming 2.75. You add another 3%. The higher the interest rate, the higher level the monthly repayment will be. So long story short, that will affect the amount of loan that you can borrow, because the cost of borrowing is increasing.
Absolutely, yeah. So I think with the rate rises coming up, or expected to come up
Yep.
in the next couple of months, or maybe even year or so, so your future borrowing potentially can be impacted. So you might be able to borrow less than what you can borrow today. Then, if that's the case.
Yes.
Yeah.
Well, I think that's part of the point, isn't it? The main reason for interest rate to be increased, the main reason, or at least one of the main reasons why there is an interest rate rise, is because Reserve Bank of Australia trying to control the inflation and indirectly,
spending.
yep, they're trying to reduce your incentive to spend the money. The cost of money is becoming more expensive.
Yeah.
Our urge to spend is lower. It's becoming more expensive. So people, even if you want to apply for the housing loan from the bank, you're not going to be able to borrow that much. So hence, hopefully, that will drive down the inflation rate.
Absolutely. I think you summarized it nicely, Justin. So I guess just to recap to what we talked about, in terms of how, what are the factors that will impact the borrowing capacity, is obviously the level of income, or how much income that you earn. I think in general, as per today, roughly, it'll be 6 times your borrowing capacity. So let's say if you're earning $100,000, and if you do not have a lot of debt, then you can borrow up to 6 times of that amount, so roughly about $600,000. And obviously the level of expenses will impact your borrowing capacity as well. So the more credit cards that you have, the more car loan that you have, and the more children that you have, obviously that will reduces your borrowing capacity. Is there anything else that you want to add with regards to that?
Maybe it is worthwhile for you to share some of your thoughts about things that customers and clients can do to improve their borrowing capacity. Obviously, we're not going to tell them to have less kids. Don't try to have kids. Have as many as you want. But there are certain things I'm pretty sure
you
that
do get a higher Centrelink income.
that's a topic for another day, right? So I'm pretty sure there are certain things that we can do to improve. So what would be the top 3, if there are 3 that you can think of right now, activities or actions that customers can do to improve their borrowing capacity?
To improve, I reckon, sit down and have a chat with your partner with regards to your living expenses. I think that's important. Do your budgeting, because obviously the higher of your, the higher your living expenses, then the less of the money that you can borrow. And number 2 is, yes, if you can, if you're trying to buy a house, for example, or get a loan, and you've got a lot of credit cards, I think it's not a bad idea as well to get rid some of those credit cards, or all of your credit cards, because that can quite heavily impact your borrowing capacity. And I mean, if there's any way where you can get a pay rise as well from your boss, you ask them nicely. So obviously, if you earn more income, then yeah, you can definitely borrow more.
So is that a hint for me to ask you nicely so I can get a bit of a pay rise?
Definitely, man. We can talk that after. But yeah, that's I think that sums it up nicely.
That's good. So at least we are sharing, we are adding some values to whoever who is watching, some tips, some actions that you can take away
Absolutely.
to help you guys out a little bit, apart from sharing all this technical stuff, which doesn't mean much if it doesn't change your life.
So how if any of the viewers wanted to reach out to you, like what would be the best way to do that, and where can they reach out?
Well, because live is going on at the moment on Facebook, so the best way to ask questions or reach out to us,
Yeah.
either Leonard or myself, would be our Facebook, isn't it?
Yeah,
So add us, send us a request, send us a message, click on the link. If there's a link underneath at all or somewhere on the page, you'll be able to reach out to us.
Yeah.
Otherwise, go Google search AA Finance Solutions. We are based in Canning Vale, Western Australia.
Yeah.
Any question, just give us a ring.
And how about for you personally? Like if they want to reach out to you, what would be the best way?
Okay, the hotline number is 0421 831 358. I repeat, it is 0421 831 358. That's a catchy number. You're not going to miss it.
Email address. What's your email address as well? It's all people who want to send an email.
Just give me a call. Send me a text.
So, okay.
Send me an SMS. WhatsApp me.
Sure.
If you prefer WeChat, call me first.
No worries. So Justin also speak how many languages?
I don't know.
I think like
Not up to 10.
five different languages.
You can call me to find out.
Give Justin a call, guys. I think he's a fantastic broker who can definitely help you out with your financial needs. And thank you so much for listening for this episode, and hopefully we will see you guys again next time. Thank you very much.
Thank you.